we have with us Mr. Ram Praveen Swaminathan, Managing Director and CEO, and Mr. Yogesh Patel, CFO of the company. I hope everyone got an opportunity to go through our financial results and investor presentation uploaded on company's website and stock exchanges. We will begin the call with opening remarks from the management, following which we will have the forum open for a Q&A session. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. I would now like to invite Ram, MD and CEO of Mahindra Logistics Limited, to give his opening remarks. Thank you, and over to you, sir.
Thank you, Shobhan. Good evening, everyone. I trust all of you and your dear ones and colleagues are well and keeping safe. I also hope each of you have had a chance to look at our results and the presentation which has been uploaded on the stock exchanges and the company's website. I'll cover in my remarks today a quick update on the current industry scenario, end markets, and how they're operating, and our strategy going forward. We'll also cover operational and financial performance for Q1FY22. Since the emergence of the pandemic, the logistics sector has been putting up a tough fight to keep the wheels running for businesses across the country. Over the last 2 years, logistics as a sector has provided tremendous support for enterprises and communities, helping cope with the global health crisis and its impact, but also acting as a competitive advantage for these enterprises. The COVID curve across the nation now seems to be in a declining phase, and we seem to be entering a more stable environment of wave 2, and is expected to reach the same level of case count as in February. And yet the challenges remain ahead of us, as there are many warning bells of a potential third wave of COVID hitting our country. This has been, in this environment of shifting sands, it's kind of hard to perfectly predict how all our markets would work. But let me provide a bit of a context about how we see end markets last quarter and going forward. And I'll begin with the automotive side. On the auto side, compared to last year, obviously lockdown was lesser. And the ease of lockdown restrictions were there for a large part of the quarter. In June, OEMs restarted operations and manufacturing in their factories, and the auto sector wholesales rebounded in Q1FY22, recording a growth of 113% when compared to the same quarter last year. Industry experts are optimistic about a revival in the industry. And while looking at comparative numbers, the actual health of the industry looks positive. There are challenges clearly as well. On the supply side, there is a shortage of semiconductors, and rising commodity prices will eventually hit the bottom line of industry participants. This may result in an inflation trend in vehicle prices, which could affect the overall consumer affordability factor, and therefore may also likely hit demand in the coming months. Moreover, there is yet some level of pent-up demand or carryover demand in the current numbers from previous months, which has to kind of sort itself out. While there are areas of concern, I think there are also areas of optimism. As we speak to our customers, many of these other companies are implementing strategies to overcome the current environment and return to a phase of growth. While the auto sector is managing through those changes, I think the longer-term trend remains positive with a return and a comeback on the overall economic scenario. Moving on to the farm sector, the farm sector remains robust despite the ongoing challenges. Overall, favorable conditions persist, and we continue to see a good demand trend in the sector, with all leading OEMs registering strong growth. New model addition by OEMs, increased adoption of mechanization, and continued measures of the government to help the sector will provide further impetus to the market. I'll now comment on the e-commerce sector. Online shopping has now been a norm for people for some time, giving them access to products from across the globe with a simple tap on their devices. Even before the COVID pandemic, the e-commerce market, driven by increased internet users and competitive prices, was showcasing a steady and continuous growth at over 20% per year. This growth of e-commerce was already pushing the entire supply chain to build better business models with greater visibility and speed. Amid the rise of e-commerce and online shopping in the pandemic times, a segment that has been propelled to newer heights is the electric vehicle segment, driven by e-commerce or the last mile delivery boom, as well as the need for switching to a more sustainable future. Electrification of the last mile is poised to be a significant part of the future of logistics. The e-commerce boom during the pandemic, coupled with the rising concern about greenhouse gas emissions, is now gradually causing a shift from diesel delivery vehicles towards alternative fuel sources. As such, electrification of the last mile is now gaining traction as a viable alternative that is sustainable in the long run and is also in line with our and our customers' environmental initiatives. The consumer sector as a whole, including FMCG, durables, and appliances, has seen a mixed quarter. While the impact on the supply chain was limited during the second wave, when compared to last year, demand from rural India did take some hit. The consumer industry has been on its feet to tackle the supply chain threats from product proliferation, increased global competition, evolving regulations, etc. To deliver differentiated products at the cost and service levels that consumers expect, supply chains have to become more efficient and resilient. With a rising focus on technical innovations as well as changing consumer preferences, the need for integrated supply management is more important than ever before. Let me wrap up the markets update with a few comments on our enterprise mobility, market. The enterprise mobility segment continues to remain muted and impacted severely by second wave and continued work from home patterns. That said, we have started seeing some green shoots in the ETMS market as an increased vaccination drive happening across corporates, is starting to result in more employees coming to work on an interim basis, if not a permanent basis. The enterprise mobility business opportunity remains strong. And we believe it has good growth prospects given the cost disadvantages of personal mobility and the operating challenges of public mobility in India. And we continue to remain optimistic about the business, this segment from a long-term perspective. Let me now move on to the financial performance for the quarter ended 30th June 2021. Revenues for Q1FY22 increased to rupees 873 crores from rupees 410 crores during the same period last year, up by 113%. Revenues on a sequential quarter-on-quarter basis were down by 10%, primarily driven by some seasonal adjustments we see every year, as well as the wider impact of the wave 2 of the pandemic. Revenue from the supply chain segment contributed 96%, and enterprise mobility contributed 4% of our total revenues in the quarter just by. Our gross margin for Q1FY22 stood at 10.6% compared to 9.7% in Q1FY21, an increase of 87 basis points on a year-on-year basis. Our gross margins have remained stable even in these challenging times, despite the severe volatility which we continue to witness. EBITDA for the quarter stood at rupees 47 crores as compared to 1 crore in Q1FY21 and 51 crores in Q4FY21. On a sequential basis, EBITDA declined by 8%, largely again driven by the drop in volume. Adjusted EBITDA, adjusting for ESOP and RSU charges, stood at rupees 49 crores in Q1FY22. Overall PBT was up 154% to 12.2 crores in Q1FY22, and PAT stood at 9.1 crores for the first quarter of FY22. PAT margins for the quarter were 1%. PAT adjusted from the RSU charge was rupees 10.3 crores for the quarter. Proportion of revenue from Mahindra Group comprised 52% as compared to 50% in the same quarter of the previous year. Moving on to segmental results, revenues from the supply chain segment grew from 392.6 crores to 840.1 crores in the quarter. The enterprise mobility segment stood at rupees 33.3 crores for the quarter just gone by. Our SCM revenue has seen an uptick driven by the overall market dynamics compared to the same quarter last year and by growing demand in e-commerce and consumer verticals. Our revenue from the Mahindra Group supply chain business grew from rupees 172 crores in Q1 FY21 to rupees 440 crores in Q1 FY22, driven just by comparable lockdown periods between last year and this year. Our non-M&M SCM business grew from rupees 221 crores in Q1 FY21 to rupees 400 crores for the similar quarter this year. Whereas it saw a decline of rupees 38 crores from Q4 FY21. During the quarter, we witnessed decline in volume as there was restriction in movement of non-essential goods for a substantial part of the first 2 months of the quarter. We have seen a strong recovery in the month of June, driven partially by underlying trends and by some pent-up demand, and we continue to be optimistic about coming quarters. Our warehousing and value-added services for the non-M&M SCM business, which is a big part of our focus, has grown from rupees 85 crores in Q1 FY21 to rupees 117 crores in Q1 FY22, a growth of 39%. Overall, the share of warehousing and value-added services, the non-M&M SCM segment, stands at 29% for the quarter gone by. Our revenues from warehousing and value-added services were also impacted by the lockdown periods. As expected, volume throughput through those warehouses came down given regional lockdowns. Our people remain our greatest asset. During the last quarter, we launched our family assistance program for families impacted by the pandemic. We continue to accelerate our vaccination efforts, and over 12,000 employees of MLL and partners have now completed their first round of vaccination. We remain committed to further accelerate these initiatives in the coming quarter. Before I open up for comments, let me just briefly talk about progress in strategy execution. Our first strategy platform is expanding services. We continue to see strong growth in the freight forwarding business. Despite the other challenges in other part segments, the freight forwarding business continues to show good traction, driven by launch of new services such as charters and expansion of accounts. Our express business grew by north of 20%, and showed solid growth. And our electrification last mile cargo business, which is ADL, continue to make strong progress. Our second strategic platform is integrated solutions. We continue to design and deliver integrated solutions to our customers across different markets and different end customer segments. We have now launched an internal program to drive a significant front-end transformation, focused on how we design and deliver solutions to our customers. On operational excellence, we have contracted additional warehousing capacity, which will be implemented through Q1 of next year. During the quarter, we started commissioning on several new multi-unit facilities, or BTSs as we call them. This included starting commissioning of our first block, or 1.5 million square feet of warehousing space in a new facility near in the NCR region. 200,000 square feet of phase one of a new BTS in Hyderabad, 100,000 square feet in Zahirabad, 260,000 square feet in Chakan, and another 3 lakh square feet in Bhiwandi. All these sites have been in commissioning through the quarter, and will see further full financial impact in coming quarters. We also continue to invest in technology and automation innovations. During the quarter, we implemented a new technology platform for our freight forwarding business, and also drove integration and deployment of our core enterprise systems for finance and HR through our subsidiaries. As we look forward, I remain pretty optimistic about the environment. Despite the challenges with impending wave 3, the company is invested in ensuring a high level of preparedness to support our customers and communities in general. And we remain optimistic about a strong outlook as we continue to accelerate the execution of our strategy in the coming quarters. With this, I shall open the floor for questions and answers.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may enter star and 1 on their touchtone telephone. If your questions have been answered and you wish to withdraw yourself from the queue, you may enter star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Dipesh from Equirus. Please go ahead.
Yeah, hi sir. Thanks for taking my questions. Sir, in the annual report, it is mentioned that you will be adding 4 million square feet of warehousing space over the next few months, and the objective is to add 20 million square feet over the next 6 months. So just wanted your thoughts on the same, because these numbers are significantly higher than your usual guidance of 2 million square feet addition every year.
Yeah. So I think, Dipesh, is that the only question, or do you have any other questions?
Yeah, other thing I wanted to ask was like your freight forwarding business is doing very well, but if you can just talk about the B2B express business, like what is the contribution right now and what is the growth expectation of the same? Yeah, these are the two. Thank you.
Okay. All right. So let me just the first one. I think the comment of our yes, as stated in the annual report in the chairman's address, section by the chairman, we have contacted 4 million square feet of build-to-suit multi-tenant facilities, which we started commissioning partially in the first quarter already. And I talked about some of those, Dipesh, and we'll go through the first quarter of FY22 of the next year. These projects are all large multi-tenant facilities, which typically each of them is at least 3 lakh square feet or above. We are building a complex, with multiple boxes near the NCR region, and we're in the process of commissioning the first 500,000 square feet of that. Further expansions are underway already in Hyderabad. Construction is in advanced stages in Hyderabad, Bhiwandi, and Chakan in Pune. We have further capacity coming up in the northeast, the eastern part of India, as well as and further additions in the western region. So yes, we do expect, subject to how the pandemic impact moves, subject to a little bit of commodity cost trends, to complete commissioning of these facilities through the first quarter of next year. As of now, we have a strong outlook in terms of demand, and do not expect any significant white space in those facilities. As regards the larger comment of 20 million square feet, I think those are future-looking and are directional in nature, and those are driven by a broader vision to reach a revenue of 10,000 crores. And we believe that to accomplish that, we will have to add, over the next few years, probably around 18 to 20 million square feet of warehousing capacity. Both of these, of course, represent a significant uptick from our historical trend line, which has been 1.5 to 2 million square feet. But you must bear in context that warehousing capacity is not something which you roll every quarter. And I mentioned this, Dipesh, in the last quarter as well, the capacity comes and goes. So it's not a linear line. But we are confident about building that, of commissioning that much of infrastructure and rolling those out. All our newer facilities are world-class by design. They are sustainable. They're ideally IGBC or Platinum LEED or Gold certified with focus on sustainability, energy conservation, and so on. Okay. As far as the other question on the express business, as you know, we essentially run a PTL / time-defined express business of our own, and this business largely operates for our enterprise customers. We don't, while we operate small packages, we don't do too many retail customers. We largely work with larger corporate customers who are part of our enterprise portfolio. Express revenues, I would guess, and I'll have to get back to an exact number, but and if you can allow us, Yogesh or SG will respond to the patient a specific number, but that business grew by 45% in last financial year, and it showed strong 25 to 30% growth in the first quarter of this year as well.
Great, sir. So just a follow-up on the first part. In the last quarter, you talked about 2 million square feet of addition for the Bajaj Electrical contract, right? So this 4 million square feet includes that number, or it is above that number?
No, it's a mixed bag. It's hard for me to pull out an exact thing because, I don't remember exactly the specific Bajaj number, but the network which we deploy in terms of fulfillment centers for Bajaj or any other customer is divided into two parts: a bespoke facility which we set up for a customer, Dipesh, and a shared facility which is in a multi-tenant location. So there is an overlap between what we had given as guidance as a potential demand for the BL account network we're creating for them versus the rest of our network. At this stage, I don't have an exact number on what the overlap is. But it is not, not all of it is within the 4 million, but not all of it is incremental. Somewhere in between.
Got it, sir. And so lastly, any change in timelines for the Bajaj Electric contract? Because last time you said it will begin the second half of this year.
Yeah, we are still on track. We expect to see broader revenue impact from Q3 of this year.
Great, sir. Thank you and all the best.
Thank you. Ladies and gentlemen, before we take the next question, we would like to remind participants to ask a question. You may enter star and 1. We have the next question from the line of Praveen Kumar from Aquitas Capital Advisors. Please go ahead.
Yeah. Good afternoon. Thanks for the opportunity. I had a couple of questions. The first one was on your segmental disclosure. In particular, we were looking at the unallocable expenditure as a proportion of the revenue. When we look at that was around 4.4 to 4.5% in the 2018 and 19 financial years. But currently it is in the range of 5.5 to 5.8%, right? So what I wanted to understand was, how do you see this settling? Where do you see this unallocable expenditure as percentage of revenue settling in the medium to long term? And also, if you can throw some light on where do you expect your consolidated EBIT margins to settle on?
So why don't I get Yogesh to answer? Yogesh, can you take the first question around unallocable expenses and the underlying trend line?
Yes, sure thing. So if you see the expenses which are unallocable in a segmental one are basically the corporate or common overheads, what would be in an organization. That includes, the digital or the tech piece which we have invested as well over the years. Now this particular portion, which you are right, in a year which was normal year, right? I mean, last 2 years have been in a way impacted by economic cycle / pandemic spread. So normalized number was in that range of 4.5% of a full-blown year, and our endeavor was definitely to that number would not, in absolute terms, not grow in the same percentage as the company grows. It means as a percentage that would come down. So it should be, in a good normalized period, as you said, in a medium to long term, trend back to that 4 to 4.5 ratio percentage rate.
Okay. And could you give us any sense on the resultant consolidated EBIT margins which you have in mind, and again, steady state, medium to long term?
Go ahead, Yogesh.
No, actually, we would not. It kind of, what we have, rolled out again from that perspective is that, our endeavor is to improve profitability for our organization, and we've kind of explained, the levers we are using in terms of, the entire business mix itself, and then even driving those operating levers on various service lines, including transportation, value-added services, and solutions pieces. So each of them have a track of, measuring, running those kaizens to improve the profitability percentage per se. In added to that, coupled with it, your answer to the earlier question, also in terms of profitability or percentage, will also go on to augment my EBITDA percentage, so to say. But combined piece is towards, combined result of these will be towards towards improving the margin percentage per se. But I don't think we've kind of laid out. But if you recall, 3 or 4 years back, or 3 years back, post listing, we kind of said that we would definitely endeavor to, on a cumulated basis, at least 40 to 50 basis points improvement in our profitability. So once things in a normal environment would be there, that's an endeavor to drive and do. And in fact, in the year F19 and F20, the same percentage was delivered also, if you would see our numbers.
Okay, thanks. That's helpful. I had another question on the warehousing revenue growth. Again, if I look at your stated goal of, vision of 10,000 crores revenue over the next 5 years, and the warehousing contributing about 30% of that. That's just broad stated goal. If I work back the numbers, that implies a kind of a 30 to 35% revenue CAGR over the next 5 years, right, in terms of warehousing. So I was trying to look at it in terms of the various components of that revenue growth. So if I look at it, if I broadly break it up into warehousing space under management growth, rental increase, and then value-added services growth, right? So if I look at the individual components, rental increase probably, it is, in the past, it's been in the range of around 4% CAGR, let's say. So the remaining bulk of the weight needs to be coming from warehousing space under management and from value-added services growth. So could you give us throw some light on these two parameters?
Praveen, I think you're right, and all I will just say at this moment, I mean, in the interest of time, is that that is why the try towards solutions and value-added services is important, because because there are two basic drivers to this. One obviously is expanding footprint, and the second one is expanding the quality of service, right? Or the revenue and margin density of the service, and we think those will happen driven by this move towards integrated solutions. So that's the big lever which will drive that growth.
Okay, you're confident of sticking to that stated goal as of now?
No, I think what we said is that if we given our vision of 10,000 crores, warehousing-based solutions and services should roughly be in the range of 30%. That's not just purely warehousing, but some add-on services, last mile transportation, etc. Sometimes it gets bundled within that, and yes, and we believe that those two go hand in hand: the vision of 10,000 crores and the 3,000 crore number.
Okay, thanks.
Thank you. We have the next question from the line of Kripa Shankar NJ from Spark Capital. Please go ahead.
Hi, good evening, and thank you for the opportunity. I had one question relating to the revenue per square feet on the warehousing side. We could clearly see that in the current quarter, the revenue per square feet has come down on a sequential basis. Is there any reason specific to that?
No, nothing. I think as I already mentioned, hi Kripa, I hope you're well. No specific reason. I think as I mentioned earlier, we have lesser throughput going through the warehouses in April and May, given the overall environment, and that essentially meant that on a year-on-year basis, also on a sequential quarter basis, there's a mild reduction. You also need to bear that while we added some capacity in the quarter, a lot of the capacity, Kripa, was still gated, and therefore was not monetizable through the quarter, right? So if you take the 156 crores and divide it by 18.3 million, and you take last quarter's number, you divide it by 17.7, there will be a difference, but it's those two factors. There is count footprint and just lower volume throughput due to regional lockdowns.
Sure. So in terms of the warehousing capacities getting added, I just want to also confirm on the e-commerce side, are you seeing a good proportion of flex warehouses also getting added over the next 6 months for the e-commerce sale? And that's not included as a part of what you had stated earlier?
Yes. So we do expect to be able to do some, I can't call it an exact number, but yes, we do expect to basically have flex capacity solutions for our customers this year as well, right? It is a slightly flatter, I think peaks are getting flatter, right, as companies manage through the peak supply chain structures better, right? And obviously this year pent-up demand is a little bit lesser, Kripa, but from a net perspective, we expect to be doing similar or reasonable levels of flex solutions for customers this year as well.
Good to hear. Just one last question from my side is on the new clientele addition. Any light you can throw on that? Because traditionally we used to give in new clients or new orders wins. If anything you can highlight on that?
No, I mean, I think we saw continued acceleration from an order intake perspective this quarter as well. What I would say is, I mean, this quarter, Kripa, a lot more of order intake was from existing clients, The pipeline has been very healthy, but we've really seen lower conversion on that pipeline just given how April and May turned out. I think a lot of people going back to the drawing boards and therefore a little bit of a slowdown in closure activity in April and May. We did see some demand flow, but not very large accounts, mostly on kind of D2C or kind of customers signing who are more physical, trying to build out digital fulfillment capabilities. But barring that, most of the business is actually from existing customers. And that's probably why that's the reason why there's no real call-out mention in the comments.
Okay. Thank you. I'll get back into you.
Thanks, Kripa.
Thank you. We have the next question from the line of Anmol Grover from Albatross Capital. Please go ahead.
Hi, everyone. Thank you for the opportunity. My question is, actually, I just need a clarification that there has been a news article saying that Milcab is being acquired by Mahindra Logistics. It's going to be mostly Mahindra Logistics. So if you could clear the air on that, that would be very helpful because I don't think it would be in the best interest of the investors to have a lot of being more with Mahindra Logistics. So, yeah.
Anmol, any other questions? I will obviously throw light on this as well.
No, I don't have any other question.
All right. Yeah. So let me calibrate. I think the two parts to this. One is I think what are we trying to do with the mobility business? And the second one specifically was on the news article you referenced. So as a matter of policy, Anmol, we do not comment on speculation, and that news is purely speculative. So at this point, I have no specific comment on that. What I think is more relevant, in my view, is to look at saying what do we look at on the mobility business going forward. So there are so really on the enterprise mobility side, it will be a couple of years, probably FY23, 24, before the market actually recovers to historical levels on the enterprise side. Work from home is a reality, and even if employees come in, given the possible emergence of hybrid work models, it will be that window before you can actually come back to the traditional enterprise mobility segments which we serve. So our focus right now has been really around how do we actually look at growing revenue streams. And as you look at growing revenue streams in that business, the focus really is on saying how do I build revenue streams where I get supply and operating synergy benefits, so we can actually see better pull through and accretive earnings, right? And we continue to look at those in the last quarter, in the last couple of quarters, as you have, I'm sure, noted in our transcripts. I have talked about some pilots we've been doing on B2B2C, pilots we've been doing on on-call services and outstation kind of rentals. All attempts to create additional revenue streams from an existing fleet supply partner fleet supply model, right? So that endeavor will continue, and that remains a very high priority for us in the mobility business. And as we and if we find opportunities around that, we will obviously look at those more closely. Now, additionally, what I will say is that any business which we invest in or any kind of new initiative we invest in is something we invest with a very high level of governance around long-term returns, right? So I take on board your concern or your comment broadly. That I just see there's a broad comment about I can input for your thought in terms of future actions we do, right? But I would assure you that with high level of governance in the board, anything which we do carries investment, but inevitably is built around strong return profiles, right, from a long-term perspective.
I would think that clarifying concerns are asked.
Okay. All right. Okay. Thank you, Amol.
Thank you. We have the next question from the line of Manish Goyal from Enam Holdings. Please go ahead.
Yeah, thank you so much. Just in opening remarks, you had mentioned about warehouses which you're planning to kind of activate over a period of next 1 year. So would it be possible to repeat the locations and the sizes which you were mentioning?
Sure, Manish. So I think one, I'll read this. I already mentioned earlier, I think to to Dipesh's question, I guess, that we are confirming that we are contracting out the build around 4 million square feet over the next 15 months. What we are right now in this stage is of starting commissioning of several of those warehouses, and specifically the ones that I talked about, I think, in my comments. Firstly was one new facility in Bhiwandi, which is roughly 3 lakh square feet, a facility in Chakan, a new BTS in Chakan, which goes live next quarter or this quarter, which is roughly 2,60,000 square feet. A new facility in Zahirabad, which is a smaller BTS. We have also started commissioning and first phase of a new BTS in Hyderabad, which is nearly 4 lakh square feet when it's all done. And we have started commissioning 500,000 square feet of a larger complex near the NCR region.
Okay. So ideally, like once you start, how much time does it take to kind of reach optimal utilization?
No, so the way it works for us at least is, and don't take this, there are risks which we take on white space, right? But by and large, it takes us roughly 2 to 3 months for us to commission a facility, right? So that's when we actually take over the facility, Manish, put all racks in, put in all the infrastructure which we want to our spec and design, etc. Typically, at the end of that 3 months, it is a monetizable contract, which and generally at the end of the 3 months, a monetizable contract exists, right? So it put it another way. Out of this capacity which I talked about, which is roughly 1.2 million square feet, which is right now under commissioning phases, there is very little white space or unsold capacity in that.
Okay.
So as those sites come on, they will actually there are underlying customer contracts which are firm and operable on the majority of those.
Okay, wonderful. And in terms of availability, like you did mention, you have contracted 4 million, but on parallelly, do you also have visibility in terms of availability of high quality warehouses and in terms of space available?
Yeah, I mean, we have Manish, our asset real estate team actually is works through with 2 large partners to continuously look at what the market has in terms of facilities, especially in target geographies of our region, and within those regions also in terms of specific micro markets which are interesting for us. Right? As an example, in Mumbai, Bhiwandi is very different from Navi Mumbai, right? Though they are both technically Mumbai. So our team is continuously looking at that. What I would say is that short cycle availability of high quality space is limited. And a lot of our approach actually is towards building BTSs from a design stage. That's driven by not just the availability of space, but also the specs we are looking at, Manish. So the specs we are looking at today are large planes. They are all, as I said, IGBC or LEED certified with a high focus on energy and sustainability in line with our ESG goals. Right? And so it's a lot of that kind of facility is just not available, right, off the cuff. Right, and therefore it ends up being. But the positive is that entire phase allows us to actually secure demand as well, because through the entire construction phase we are normally securing demand, and that's why there's lesser white space.
Okay. And last question on in your opening remarks, you did mention about overall M&M revenues at 53%. Is it right?
52%, I think, was my specific comment.
52%.
Yeah, for the quarter, I think, if I'm not wrong, and I don't have my comments in front of me right now, but I think it was in the range of 52%.
Yeah, because supply chain management is 52.3%. So I'm just wondering, for enterprise mobility, do we have any revenues from Mahindra anchor customer?
Historically, they're not an anchor customer. We had some revenues, but from the technology services parts of the group, but those really have died down, have come down substantially, and therefore very marginal now, given the overall mobility environment.
Okay, fine. Thank you so much. Thanks.
Thank you. Before we move to the next question, we would like to remind participants to ask a question. You may enter star and 1. We have the next question from the line of Vikram Vilas Suryavanshi from Phillip Capital. Please go ahead.
Hi, Vikram.
Yeah. Hi, sir. Good evening and congratulations for strong numbers in challenging time. Sir, if you can give, if you look at last 2 years, we had very good improvement in working capital. So how is the situation, particularly on receivable side, and how is cash position now? If you can share that. That is one question. And the second thing, we continue to see good traction in e-commerce and consumer. But if we expand that kind of, what are challenges for similar growth in other segments, particularly in engineering or retail or any other domain? Or that is how is that growth shaping up in different segments? And as a company, will it be profitable to stick to select few domains to leverage network or the kind of assets we have, or we are flexible enough to diversify into different range of industries? So if you can comment on that. And third, last question was about this acquisition of electric vehicles, what we were planning last quarter. We I think had a 300 EVs. So how is that ramp up is happening?
So let me take the last two first, Vikram, and I'll hand it over to Yogesh to comment on our overall working capital and cash reserve situation, though they did not find comment in my opening remarks. I think the e-commerce and consumer, while you are seeing positive traction there from a headline perspective, we've had client acquisitions in the auto and engineering space as well. Those have been clouded obviously by the overall economic environment or the demand environment in that space, Vikram. And as we start seeing broader economic, I mean, we had an economic demand challenge in the auto segment in FY19-20, as you would remember very well, and then of course COVID coming in the back of that, and now supply chain crisis is in that segment, not in that market. But on an underlying basis, we've had new account additions. In the past, I've addressed our focus, which is really on discrete manufacturing, especially outside pure auto, on the engineering side as an important area for doing account acquisitions. The other one is comps, our auto component companies, and we have continued to do additions in that space, though they have not materially showed up in the numbers. We have not been able to offset the decline of the overall sector as a whole, the headwinds. From a strategic focus perspective, we think the choice is not about markets, the choice is about value addition. So I think across the businesses, what we are focused on is saying how do we create a compelling value proposition, right, instead of just searching for revenue real estate. Right, and so in the last couple of years, we've done that a little bit more, and we do that more periodically, but as we've done that, we've actually defocused from some segments as well and enhanced our focus in some others. And that remains our kind of our guiding philosophy, right? To look at markets where you can choose your markets based on creating compelling value propositions, which are accredited to customers, communities, and shareholders as well, right? So that remains the focus. I think the electric vehicle business is making good traction. Obviously, some registrations and fleet deployment was slowed down in this quarter given the overall situation. Some states are still being worked on in terms of local registration. There's been a change in phase 2 subsidies and so on. So the moving parts in the quarter, but broad direction remains extremely consistent, and we are very focused on driving the ESG and sustainability agenda and embedding it in the way we do business. Okay. So with that, Vikram, I'll hand it over to Yogesh to provide some color on the working capital side. Yogesh?
Hi. So Vikram, from a working capital perspective, I mean, you would have noticed that last year we did drive a significant progress in collecting those refunds on our taxes, which were kind of blocked some part of our working capital, which if I look at year-on-year basis, it would have reduced my working capital blockage by 3 days. In addition, I mean, we did manage our DSO to DPO delta, in a spend. So overall, our working capital, would be in similar number of days what you would have seen. A certain amount of value shortage would have just played a denominator effect. If I were to tell you in terms of cash bank balance status, just to get you an understanding of it, we had when we started the quarter, we had about 253 crores of surplus cash. We almost retained all of it. I mean, probably it was negative 2 crores for the quarter after funding for the capex which we did in the quarter.
Got it, sir. Thank you very much.
Thank you, Vikram.
Thanks.
Thank you. We have the next question from the line of Niranjan Sakharkar from Aquitas Capital Advisors. Please go ahead.
Yeah, thanks for the opportunity. I had a couple of questions. The first one would be, what impact would you see on a warehousing margin, assuming e-commerce contribution goes up? So that is one. Assuming that the scope of value-added services in e-commerce is significantly low compared to other segments like auto. That is question number one. Question number two would be, how would you benchmark your technology against this tech-enabled startups like, say, Delivery or Rivigo, and maybe what edge do you have over them, specifically in e-commerce segment?
Hi, Niranjan. Great questions and very insightful. So as far as warehousing in e-commerce and impact is concerned, I think you have two broad kinds of warehousing solutions and services in e-commerce. The first one, which is more of a service type, is really storage-based systems. Storage-based services where you're just basically doing inventory differentiation down the value chain. The second one is actually more complex things like returns processing, sortation facilities, fulfillment facilities, where we are picking, packing, and processing items. As you pointed out, the margin profile of pure storage systems is always, notwithstanding which end market it is always lower than the demand for or margin profiles of processing-based services solutions. Now, in e-commerce, the density of processing-based solutions is actually a little bit higher than more conventional markets like auto, where there are things like high-density storage systems and so on, but inherently they tend to be storage. And there's, of course, there's some value-added things there like kitting, value-added packing, pick and ship, direct online shipment and so on, GIFs and so on. But intensity of fulfillment and sortation is actually higher in e-commerce. So broadly, I think if I had to, our strategic focus is actually on those more value-added areas, which are like grocery, returns processing, that sortation and so on. So at a headline level, I don't see an unfavorable impact of margins, given broad e-commerce growth. Okay, so that's just one data point. I think the second one, which you had really was around technology differentiation of us versus startups. So I think if you look at the startup ecosystem, or not just using startup or new age companies, or different ways you could use, I think there's two forms of technology which is lever. There are two kinds of companies. One, I think, are companies which are single service companies. They just do last mile delivery, or they just do line haul, and they use technology, or in some cases automation or IoT, etc., to enable that. And the focus there is how do they run the network optimally and more efficiently, to be able to leverage that. The second group, it's a smaller group of companies, are people who actually provide integrated solutions, which are really broad end-to-end fulfillment. And those companies, will essentially have to have technology stacks of different services coupled together in some form, right? Now, at Mahindra Logistics, we actually are focused on creating an integrated tech layer. What that means, Niranjan, is that we have individual tech stacks for specific service lines. So we have a TMS for transport management for line haul. We have a TMS and a network management system for our express business. We have a network optimization platform for our electric vehicle fleet. We have warehouse management systems for traditional WMSs, as well as traditional facilities, as well as fulfillment models. And we have an integration layer across all of these, which allows you to drive visualization and analytics across across all those stacks, and also drive optimization across those stacks. So that's kind of our vision for our technology. When we look at our technology, we don't look at technology as as a tech company, but actually as a tech integrator. So a lot of our technology is actually partner sourced and partner evolved. And we really drive integration across those stacks, leveraging our partners' capabilities instead of trying to do it all in-house ourselves. So as an example, this quarter for our freight forwarding business, we went live with CargoWise, which is the world's premier freight forwarding platform. And that covers CRM, customer service, track and trace, integration with liners, and so on. And that individual service line integrated with other service lines provides our ability to drive and a tech perspective across the entire supply chain. Right. So that's our focus. So it's a bit different from probably some of the new age companies which I just referenced today. There are, of course, pure tech-based new age companies or aggregators like Blackbuck or Locus, which are either aggregator platforms or are providing technology to other companies. I hope that clarifies.
Okay. Yeah. Thanks. Thank you for that.
Thank you. We have the next question from the line of Mandar Pawar from Kotak Mutual Fund. Please go ahead.
Good evening, sir, and firstly, congratulations on a good set of numbers in this tough quarter. So my question is related to the auto verticals. We in the two-wheeler space specifically, we are looking at some new entry of new players in electrics, and with they're talking about a differentiated distribution model, bypassing the dealership, etc. So from logistics players' perspective, like us, what does it mean in terms of the potential, new business opportunity? Because from the OEM's perspective, whether that budget meant for the distribution shifts more from the dealers to the logistics service providers, is that a business opportunity to capture? If so, are we present in this kind of opportunity? And if, let's say, this kind of a model works where the deliveries are direct to the customers, in terms of, because I believe the warehousing and the transportation need per 1,000 vehicles or per million vehicles would be more. In terms of revenue, will it mean that it will be a bigger opportunity?
So Mandar, any other questions, because we couldn't take it together?
No, that's the only question I have. Yes,
right.
Thanks.
Yeah, it's a great question, and I think at this stage that entire space on two-wheeler EV is evolving. Obviously, a huge amount of energy and action there with Ola, Ampere, of course, Hero Electric, TVS, Bajaj now with Chetak, the new Chetak, etc. So a lot of action in that space. But thus far, so two ways to look at it, right? I think in terms of a long-term, medium to long-term future, Mandar, there are multiple possibilities, right? And those are still evolving, right? And a lot of companies are whiteboarding and seeing how they will create differentiated service for customers and how we can leverage supply chain design for that. That said, in the short term, volumes are still pretty small, and therefore the larger focus in the short term is to be able to provide them a more conventional service, albeit with probably often smaller order quantities, because volumes are as large as a more conventional petrol or gasoline bike, where you just fill larger vehicle capacities for it. So short term is a bit different from what the medium term represents, Mandar. And we are right now in discussions with several two-wheeler EV manufacturers and three-wheeler EV manufacturers as well on what we could do as potential solutions for them. But I don't think there's a clear secular trend which actually emerges across them yet, at least to the extent of our conversations.
Okay, got it. But we have the capability already, or is it a very differentiated, solutions and capability set of capabilities which is required? Because it's not the traditional hub and spoke, right? It will be more from factory to customers. So in terms of our readiness,
yeah, we have that ability, and I think it depends a little bit on each company's own choice, right? So some part of the middle mile will essentially probably end up being consolidation of vehicles, but obviously there are interesting models like enhanced level of customization for customers. Therefore, therefore delayed manufacturing and models and delivery systems to support that, D2C models like you mentioned. So multiple possibilities exist. At this stage, I don't think we have come across something which we can't do, Mandar. Let me put it that way.
Oh.
Okay.
Oh, got it. Yes. Thanks a lot, sir. Thanks for it. All the best.
Thank you. We have the next question from the line of Pranay Roop Chatterjee from Burman Capital. Please go ahead.
Hi everyone, am I audible?
Yes.
Yeah. Good evening to all. Hope you are well and safe. Great results in a challenging time. I had only one question, and this was specific to the lease rentals that you pay to your warehouse owners, right? So recently I read that because of disruption in the steel supply chain, the raw material for building a warehouse has actually gone up. But the warehouse developers have not been able to increase the rentals. They have not been able to pass it on, which is why their margins are pressurized. So how did you actually see this play out in Q1 numbers? And if actually they increase the rental yields, how are the contracts structured? So are you able to pass it on to your customers as well?
So I think it's a complex question because a lot of variables in it. But simplistically, I think there are two things which are accurate. I think one, from our context, I think most of the developers we have been talking to and working with have obviously seen escalating commodity costs, and that's resulted in either a higher cost of construction for them or in several cases delayed construction, right? As they try to kind of best manage their cost structures. Now, so that's one. From our own perspective, we have really not had any increase in rentals because of this increase in commodity costs. Right, in the existing fleet or existing properties which we operate. Some of the newer ones which we are contracting, we are seeing some inflationary ask. Whether it's accepted or not is a very case-to-case situation. Now, as far as our contracting is concerned, there is a mixed bag of contracts, and some of them, almost all our contracts actually carry an annual escalation element around warehousing tariffs anyway. Right, and therefore there is some flexibility. I said broadly there is flexibility, possibly with some lag to actually pass on costs if they actually increase on existing properties. On new properties, anyway, those costs are baseline into our financial model.
Got it. Thank you so much.
Thank you.
Thank you. Ladies and gentlemen, to ask a question, you may enter star and 1. We have the next question from the line of Shivaji Mehta, an investor. Please go ahead.
Hi, thank you for this opportunity. I just had two questions. Number one, wanted to understand
Mr. Mehta,
the new customers.
Mr. Mehta, I'm sorry to interrupt. The audio from your line is not clear, sir. Could you adjust?
Is it better? Is it better now?
Yes, it's better. Thank you.
Right. I just had two questions. Number one, the new customers that we've added, say, in the last 2 to 3 years, what would be the contribution of these to our revenues? Number two, on the warehousing front, just trying to understand these new warehouses that will be coming up, they'll be mostly on a lease basis or would we be owning these warehouses?
I can answer the first one simplistically. We don't own any of our facilities. We lease all of them. Okay. Hello,
can you hear me?
Yeah, we don't own any of our facilities. We lease all of them.
Right.
Okay. The building and the property itself, there are stuff inside that we often own, like racks and energies, or conveyors and so on, but we don't own the buildings themselves. As regards the contribution to our overall revenue, I don't have a number off the cuff, unfortunately. We'll have to come back to you, or let's check if Yogesh has an estimate of that. Yogesh, any sense do you have?
No. So each year you would have to accumulate. I mean, the question was since, over 3 years, whatever we acquired, so that we'll have to just bring it up and share separately.
Okay, sure. Thanks a lot.
Thank you. Ladies and gentlemen, to ask a question, you may enter star and 1. As we have no further questions, I would like to hand the floor back to the management for closing comments. Please go ahead, sir.
Thank you, everyone. I hope we have been able to answer all your questions satisfactorily. However, if you have any further clarifications or would like to know more about the company, please feel free to contact our team of SGA, our investor relation advisors. Thank you for your continued interest in the company. We remain committed to driving long-term value on the back of our strategies execution, and we look forward to your continued engagement and support. Thank you all once again, and please stay safe and wish you the very best. Thank you very much.
Thank you, gentlemen. Ladies and gentlemen, on behalf of Mahindra Logistics Limited,